What up? It's Ruben from TG, and in today's video, I want to show you how to make a simple option trading strategy that you can use so you can have results like this, and you can have results like the SMCI trade that we've got in for 57% gains. We keep it really, really simple when it comes to trading options, and I'm going to share that with you so you can do the same thing too. Um, Okay, let's talk about how this works. Okay, I'm just gonna start a new thing here. I say simple option trading strategy. Okay, and the thing with this is that a lot of people tend to mess this up. Okay, they mess it up because they get too caught up with their emotions. Now, if you can reframe yourself from being emotionally attached to a trade, you're gonna win a lot. Okay, but that means that you have to swallow your pride and your ego and size in accordingly. Like if you have I'll give you an example. If you have $100,000 account, I tell everybody, do not go in with more than 1%. 1% is $1,000 for a trade. 2% max for option trading, $2,000. A lot of people think just because you have a six-figure account, you should go in with 5 grand, 6 grand. That should not be the case because you have time against you. Okay. There's a lot of traders that I talk to, literally. They tell me that they had a $300,000 account. They put in like an absurd amount of capital and they blew it. Now they're down to $20,000. That sucks. Okay. So before you even consider trading, make sure you have your sizing correctly. I have a whole video and an article about how to size in correctly. Okay. When we're trading shares, it's a different story. You can go in a little bit heavier, 4 to 5%, because they're shares. You're not against the clock. And you should have a strategy again that on average you lose about 3% on the stock, but the stock can move about 20 to 30%. That's a good risk versus reward, right? You lose three, if you can make 30%, that means you can make 10 times more than what the stock loses, right? That's a really good risk versus reward, and you will win more profit than you will lose money, right? Simple, profitable. All right, that is how, again, I'm able to achieve this. And because the risk versus reward on this strategy is so high, naturally, my win rate is actually really low. This is a question I get asked too, like to this day. What's your win rate? It's like 50%. It's not like a whole lot. It's not like one of those crazy like 70% win, because we're not taking profit at 20% returns. Like I just showed you, a lot of the trades that we take, we're looking for 70, 100% ROI, but that requires you to have a strategy that accounts for that. And that's what I'm going to share with you today so you could do the same thing. Okay. Now I'm going to share with you how I do it, and then you could do the same thing too. All right. Now, there is something I do have to preface here, is that I use a tool that I personally build, that it personally gets data from the market, from the option market, from the equity market. It computes everything together and it gives me the best, at least in my opinion, I might be biased, but the most reliable support and resistance levels and the most accurate price targets that I can aim for. Okay. And so I built a tool, and so because of that, I think it's the best tool, but it's what's helped me and my teammates make a lot of money in the stock market. Okay. So say what you want about it. You don't have to use my tool. If you can find something similar, awesome. But I think it's awesome. All right. So what do I do here? Okay. So first, like I said, how do I come up with this trading strategy? Now, for me in my own retail mind, for me, it's very support and resistance levels, and then also something that we call expected move. And this is all baked into the application that I use. Okay, so support and resistance level. First, step number one: mark support and resistance levels. I'm actually going to show you an example here with SMCI. which is a trade that we took. Okay, you can see these like magenta colors. You can see here I have this 60. This 60 level right here has a keyword here called MR. MR means max reward. That's what that means. Okay. I also have another line here called QEM, which is my quarterly price target, essentially. Okay. And this was 61.96. And you can see here we literally tapped into before MR, which is the biggest area of liquidity. Okay. The biggest level of potential resistance. And then also we marked 61.96 as the ideal price target to sell our lead contracts. Now, these are not like random. Like you can see how specific they are. 61.96, and it's rejecting practically right at the line. Okay, these numbers are so random, but they are calculated based on implied volatility, based on the option Greeks, and the contracts that are coming in. Right. So let me show you this tool. Okay, because this and also step number 2, which is set quarterly price targets, comes from my tool Gextron. Okay, now this is the pro dashboard here, which is there's a lot going on. It could get a little bit confusing, but on the left hand side here, this is a tape of the equity tape. So all the contracts that are coming in. On the bottom here is literally every option contract that's coming in. You can see here somebody purchased $92 worth of premium. Like you can see here, right? So I have the entire tape for the option. I have the entire tape for the equity. And this is something that my students that I coach, they all have access to this. Hence why they're able to have more accurate support and resistance levels. Again, maybe I'm just biased. And then on the right-hand side, I have unusual option orders. Now, when I come here, I'm given these daily levels. These daily levels in Gextron are updating throughout the entire market session from since market opens till market closes. So it's always shifting these key levels. They're making the bars either taller or shorter based on option activity, right? And so going back to our step here, mark support and resistance level, it's really, really simple. All I have to do is just look for tall bars. In this case for SMCI, because I'm looking at SMCI, we have 60, 63, 65, and then at the bottom 55. Okay, and all I have to do is mark these levels. And so what I do here is you can see here I have 60 here, I have 55 at the bottom. It used to be 55 used to be max reward, but that changed. It's just a regular. We call it area of interest. The tallest positive bar is max reward, and that's our way of saying, okay, like this is this doesn't mean it can't go any higher. It just means that there's going to be a lot of resistance here, a lot of liquidity. Usually, a lot of folks look for liquidity grabs in like the highs and the lows of a swing, but that's like technical analysis. That's looking at the past. The way Gextron does high liquidity, which is pretty much max reward, is based on option activity, based on the option Greeks. Where are orders being placed at? And so it's going to tell you, hey, there's a lot of activity in this area. It might be this whole zone right here for 60 may be max reward, which may be where a lot of liquidity is going to be at. And you can see here, we're literally rejecting here since Tuesday, and today it's getting rejected around this zone. It doesn't mean it has to be right on the strike level. It just has to be around that zone. And you can see it's getting rejected very, very intensely here on the daily time frame. Okay, now with that being said, I marked these levels. So again, 60, 63, 65, and 55. Now, I do have to mark something here called P-trans. P-trans is a zone where it tells us where it's like the final support level. It's the final support level where it's like bullish momentum starts, and if it goes below it, it ends there. Now, you may think like, oh, that should be 55. It's not 55. The way we do it inside for my students is we say it has to meet a minimum of 4 positive bars consecutive, right? So 1, 2, 3, 4, awesome. So 58 is P-trans. And so I have to mark that level there. Okay, so 58, I'm going to say this is P-trans. And I like to label these as P-trans so I know, hey, this is where positive transition goes from bearish to bullish. And as long as we can stay above P-trans, it's the final support. Otherwise, I may have to consider about getting out. The only way we get out of our trade is if the data changes. That's how I get out. Okay, it's not based on my emotions. It's not based on what I see on social media. It's based off of the data. And Gextron literally has access to the entire equity tape and the option tape and all the data. Okay, so I don't have to make emotional guesses. I just have to see what Gextron is telling me, and then I just follow. That's it. Okay. Now that I have these levels marked, okay, these are just support and resistance levels, right? What I need to do is now set quarterly target levels, price targets. And the way you do this is like this. Every ticker has earnings, right? That week of earnings, whatever the expiration is, that is your quarterly cycle. That security, that's where the quarterly move ends. So in the case of SMCI, their quarterly ends on August. If we take a look at something like MU, their quarterly cycle ends, see, it already happened here on June. Their next quarterly cycle ends in September 25th. So what we do is I like to mark these levels as soon as their earnings pass by. I like to see, okay, maybe like 2-3 days after, I say, okay, where are the next ranges, right? The next price targets to the bottom and to the top. And so what I do is I look for the expiration closest to the next earnings, right? So if I'm looking at SMCI, as of right now, which is going to be next week, I'm looking for August 8th here. This is the week that they have earnings. I'm going to say, okay, the quarterly top is going to be $69 and the bottom is going to be $53. Okay. And the way Gextron does that, it's based off implied volatility. So when we're setting price targets, it's not about looking on the left-hand side to see like what are the levels, what are the price targets here, because the market doesn't care about the past. It only cares about the future. And you can only get that from implied volatility. Hence, implied volatility literally means expect and move. That's pretty much what it means. It's based off what market participants believe price will be at whatever the future price of that security is going to be, right? And so the thing about Gextron and where it's accurate is that it takes into consideration implied volatility. It takes into consideration the current pricing market. It takes into consideration theta, okay? Because the thing with options is that theta, is designed to destroy everything. So like it takes into consideration all that, giving me constant, reliable targets every single day, throughout the day. Okay, so that's what we use. This is how I set my targets. This is how I'm able to say, okay, the target for SMCI is good. Like we already finished it. There's nothing else to do. We hit our target. We're going to sell our leaps, and now we're going to maybe just play small and see if we can capture more or less, if it decides to fall. I'm going to show you another example here because this doesn't work just for quarterly targets, but this also works for yearly targets. Upstart, okay, this is funny because I got to let my team know about this. I told my team, hey, based on Gextron's data, the end of the year target for Upstart is 8650. It's a weird number, right? This is a number that just Upstart Gextron told me, and we hit 8650, and now we are rejecting on the daily time frame. Okay, and so that tells me that okay, Upstart has met the yearly expected move. If earnings comes, it could reject. Okay, because tickers move in quarterly cycles, and once it's something that's met, it could go higher, but it's more likely to come back down, to correct, find a level of support, to then go up higher. And that's all dependent if they have good earnings. Okay. So, next thing that we like to do here, we like to figure out EPS growth. This is really important. Okay. Because any ticker that we look into a swing trade here, we're looking for, does the company have growth or not? And if they have growth, then we want to capture that move, right? So in the case of, and you can do this just by going to the NASDAQ website. Okay. So we're going to go to the NASDAQ website here. For example, let me give you an example like MU. We're going to go to their earnings tab here. Okay. So MU is a ticker that we love a lot. We totally believe that this is a good ticker to hold for the next couple of years, because if we take a look at their annual growth, we're like, the forecast is about $7. Then the next year is going to be 14 and then 16, right? This is like 100% growth. Last year, I believe it was like $1 and some change. So it's growing at a rapid pace. We want to capture this entire move. Now, we're trading this. So it's not just a buy and a hold, which you can do that too. But we're trying to trade this and maximize the profits as much as possible. And the way we do this is by figuring out yearly expected move, which you could get from Gextron. Again, that's where we get it. And then also the quarterly expected move. Okay. So in the case of MU, if we take a look at MU, we started a position on MU here for a leap. Not a full size, just a bite. Okay, because when after the earnings was released, we calculated the expected move, which again we received from Gextron, and it said the quarterly expected move is going to be 100, and the quarterly expected top is 140. Now you can see here price has practically clouding pretty close to the 100. So we started a position here with Gextron here. I'm sorry, we started a position here with MU at 112 because we're above P-trans. But I'm aware that we haven't met this side yet, so it could still fall down. Okay, that's why we only started a small position. If we get more buying pressure on the daily time frame, on the weekly time frame, then we'll probably add a full size position and then aim for the expected move over here, which is 140. And until MU finds a bottom, that's that, right? So it's about playing these ranges and figuring out what levels is in front of us to get into this range. Like, what are the key levels? And if you can figure out those key levels, then you have a map. You essentially have a map of like, okay, I want to get to here, but I know that this is a weak level. I know this is a weak level, but this is a strong level. So I might want to sell the majority of my stuff here and see if my runners can hit the quarterly expected move, right? That's essentially what's going to happen. Okay. Super, super simple. And it's really, really easy to think about it too, because if you really think about it, like if the price of if MUs continue to grow in revenue, then, and this is the expected bottom, it's technically cheap, right? It's technically cheap. Like you're getting MU at a discount. It doesn't mean it can't go any further down, which it did for a long time. Okay. But the point is like you want to try and play these range bounds, right? If you're near at the bottom, then you can start position and so on. Okay. So that's EPS growth. Okay. Now, when it comes to option selection, when we're trading things like SMCI, where it's a leap trade, we're looking at quarterly moves. We like to get about 8+ months out to give us enough time, because we're talking about a whole quarter. That's 3 months. To see the quarterly expected move, it could take anywhere from a week to a whole 3 months. We don't know when, but or isn't not like we don't know if it's going to happen. We just need to know like when it's going to happen. And the way to fight that is by getting time. Okay. And when it comes to the next part, which is the most unsexy part, is the risk management. And honestly, this is where it matters the most. Okay. Because our win rate is about 50%. We cut positions and we go in and out of positions often. And 50% of the time, we're losing 2 to 3% on the stock move. But we're also winning on the winners. We're making like 17 to 25, 30% growth on the stock. Okay. Like SMCI, when I first called it out inside the Telegram group, we were trading this when it was $45. If you take a look at where $45 is from then, we've gotten about a 30% upside move. Hence why we make so much cash on it. Why we can lose like a 2%, 3% stock move on it, but our winners are making up 35% move to the upside. That's a solid move, right? So it's all about, in conclusion, in conclusion, conclusion, okay? It's all about RVR, risk versus reward, okay? Size small, yes, and that's it. Size small, and it's all about RVR, okay? This is the simple strategy that we use. It's about 4 or 5 steps. It doesn't take, it's not very complicated. A lot of the hard work is already being done by Gaxtron, okay? Because if you were to do this manually, you'll spend more time doing math throughout the day than you would actually trading. So that is the simple, profitable option trading strategy that we use. It's how we are able to lose, 3% on JD shares, but capture a ton of the move of SMCI to the upside, about 37% move to the upside, right? And we're making money off of that in options. So it's even more profitable than the shares with less capital, right? So that's the simple option trading strategy. If you have any questions, drop them down below. Actually, let me see what else is left here. Somebody had a great question here, and I want to address it here on the video. They said, all right. They said, Kevin asked, saw your video on SMCI. When are you looking? When you are looking at 3-6 months out, do you buy at a desired delta, 3 to 84, and ignore the strike price, or do you get at the money or one out of the money strike? Is delta more important or strike? Is delta more important or strike price? How far out of the money would you suggest to go to keep a good delta? Okay, so to answer this question, everything is about delta. Okay, it's not about the strike. The strike, if you got to think of delta not just like the surface level definition, which is what this whole community is about. It's about using the option premiums for probability in math. So delta is like a probability measurement. Think of it this way. If you have a delta of 50, you have a 50% chance of going for that strike to be in the money by expiration. If you have a delta that is 99, you have a 99% chance of that strike being in the expiration. A lot of, like I said before, what makes options dangerous is theta, because any out of the money contracts are going to go to zero by default, by expiration. And so what you want to try and do is you get an out of the money contract into the money as quickly as possible. And so if you pick deltas that are, anywhere from, what did I say, 45 to 38 delta, you have a really high odds of that strike going from out of the money to into the money. The lowest I would go is 25. And that's just in case you can't afford the other ones. But don't opt in for like cheap deltas, okay? Because it just decreases your odds. You want to pick quality option contracts. You don't want to pick stuff that's so cheap and just, there's a reason why it's cheap. It's low odds, and you're gonna end up losing more money than you will be making money. So give yourself the odd to win. All right. So, yes, deltas are more important than strikes. How far? Like I said, anywhere from 38 to 45. All right. I think that was a good question. If you have any questions, drop them in the comments. I'll answer them in this format as well too before I get into my videos. And if you want to trade with me or check out Gextron, I'll put a couple links in the description, and I'll see you in the next one. Peace.